Hey, what's going on, Wealthy Legacy Journeyers? Welcome back to another episode of the Wealthy Legacy Journey. I'm your host, Kendell Liden, and this is the show where we talk about building wealth on purpose for a purpose. And the title of today's episode is Actions Speak Louder Than Words. Organize your priorities. And really, I first I was thinking of just calling it organize your priorities, and then I thought about this phrase that honestly I had just drilled into me growing up. My mom especially said it over and over and over. And anything that we did, your actions speak louder than words, and it's so true. You can say that you're trying to get out of debt, right? But if you're continuing to buy things on credit cards, then your actions speak louder than words. If you continue to buy all of the frou-frou extra stuff in life, and you're not trying to attack that debt as aggressively as possible, well, your actions speak louder than words, right? If you're not looking how to increase the cash flow in your life by making those uncomfortable moves, short-term sacrifices for long-term gains, well, your actions are going to speak louder than your words. And so really give a hard look at your life and look at your goals. Last week we talked about figuring out where you're at, where you want to go, what are the steps it's going to take to get there, and then taking the next right step and making sure you're going after that next right step as aggressively as possible, that it's your all out focus, it's your number one goal, and nothing is going to get in the way of your success or your momentum if you can help it. Obviously, there's sometimes external factors that come at us and we have to figure out how to pivot, move, and change, and I totally get that. But as far as what you can control, and I think that sometimes there's even things in our life that we would say we can't control, even though we can control it. How do we gain control? And a really great movie that I watched this last week, and I'm actually going to tag this in the description of um, the YouTube video and of the Spotify podcast. Let me actually just make sure I add this note here. Link to movie. I watched this movie this weekend, and it was so good. It's A Family Man, and basically the premise. I don't want to give away too much of it, but he was a businessman. He was successful in what he did, but he really put his family on the back burner. There was this major family event that occurred that caused him to step away from his business role a little bit to focus in on his family. And he realized how much he had neglected his family through this process, started pouring into his family. And it was just really a great story of reconnecting, setting your priorities right, and making sure that you're focused on what's most important. And it gave me some perspective because actually just the day before something like that, I had taken a call at 6 p.m. A contractor was calling me that was trying to go out to a property, on Saturday. But it's not just like a one-off thing. It's not. This has been happening quite a bit lately. And we were out to eat ice cream as a family. I had taken the kids and Libby to get some ice cream and just enjoy a little bit of splurging. And since we've had a couple wins lately, and while we were there at ice cream, I took this call for the contractor, and I just that kind of was just resonating with me. And my wife was even telling me about somebody that we know that recently has taken multiple business trips for different reasons, as they're trying to continue to grow in their role and climb the corporate ladder. And I was like, man, but like, why? And just realizing like climbing that corporate ladder, all you do is like you make more income, yes, which is great if you're trying to pay off debt, if you're trying to increase the cash flow. But at the end of the day, like you're not really climbing the ladder of life unless you are doing something that ultimately fulfills the purpose that you're set on this earth for. That's definitely one way that you can be climbing the ladder of life. And then the other way you can be climbing the ladder of life is by building assets and wealth in order to further fuel your ability to do what you were called to do, right? This is a show we talk about building wealth on purpose for a purpose, right? So on purpose meaning we are learning how to take our extra cash flow and increase it, right? That's being very purposeful. Me selling my house, moving into a fifth wheel, it's very purposeful actions, very intentional actions, but for a purpose being, what is my God-given calling? What is it that I'm set on this earth to do? How do I give myself the freedom to be able to live that out? How do I give myself the freedom to give away, the average annual salary? That's what I'm able to give away in my giving fund, and I still have plenty of extra coming in to be able to reinvest. Like, how do I get to that point? So that's, on purpose is the intentionality. That's your actions, speak louder than word. For a purpose is being able to be intentional with those gains once you've realized them. Another thing is, in the next morning on Saturday morning, I took a call for a contractor, a phone sale at 8 a.m. It was Saturday morning. And through the week, I don't really mind, odd hours here and there for contractors. But Saturday morning, I was sitting there having this conversation with Libby, and I got this call from the contractor. And I had to pause our conversation, take this call, do this phone sale. And by the time I got back, like, she had already gotten up to go cook breakfast. And I realized, just like that moment, time was lost. And realized, like, this is just not working for me. I'm working for it. The fact of I take these calls, it doesn't necessarily get me any further ahead or behind. I work salary, or even if you work hourly, it's not going to get you that much further ahead. Now, if I'm taking a call on a deal that, at this stage, I'm sure people take calls for a lot bigger deals at later stages, but at this stage where I'm like, okay, if I take a call where I could make, 5, 10, 15, 20, 30 grand, off of that phone call, that's helping me move towards that goal. That's awesome. Um, and I'm willing to continue taking the steps, but that's because I know, hey, right now I'm at this point, but taking these calls, doing this hard thing is going to help me double and then double again, and make the moves in the right direction. Um, Oops, sorry guys. And um, so another thing, and I just want to share just some of the difficulties, the interesting things that have come up this week. Well, firstly, last Sunday, Charlie went to his new home, and at the end of last episode, I actually got pretty beat up about it. And as I was sharing that, by the time I record the next episode, like, Charlie won't be here anymore. I miss him, I do, but it's been nice. It's been a weight of relief of responsibility, a weight of relief knowing that, like, he's went to a farm where he has his job back. It's something he really enjoys to do. We watched him flourish in that role. Um, and they've sent us some updates. He's settling in well there, and we're really excited for Charlie in his new chapter in life. It's also kind of put us in gear where it's like we're ready to move now. Like, it was kind of like a big rip the band-aid off moment. Charlie's gone. We're ready to finish up the last few things and, be able to move on to this next season of our life. We're very excited for it. So that's been really cool. Exciting to see that, on the horizon. Another interesting thing that happened is the line, our washer line, praise the Lord, not in the wall, but actually the one that comes from, like, the wall, and then it is the hose that, attaches from the wall to your washing machine. It busted on Saturday at 2 a.m. So Saturday at 2 a.m., Libby and I are up cleaning up water. Praise the Lord, there wasn't a ton of damage. Actually, lady had some stomach problems that night. Woke up Libby. She went to the back door. Our laundry room's there in the back of the house, and that's when she saw that there was just water everywhere. She came, woke me up. She's like, Kendall, there's a problem, and we figured it out, got it cleaned up. So praise the Lord, it didn't go on for hours and hours until we woke up in the morning, because the problem would have been a lot worse. But we hit that too, and it's just there's been a couple things. We also we, like, literally we haven't had anything happening to the house up until, like, just now, and it's like, just kind of putting this distastefulness for us in our home, which we love our home. But another thing that just came up is we've got to have the pest control guy out, and just little things like that, they keep popping up, and all of a sudden it's just like, okay, this isn't the wonderland that it was for us. This wasn't, isn't the retreat that it once was for us, after a very difficult season. It's starting to present its problems. Not that we're going to throw these problems onto somebody else. I'm going to take care of everything, but at the same time, it's like, okay, we're getting ready to definitely, move to our own place. So those are some of the challenges. Something that I want to tell you, like, two ways to be intentional, though, and these are some notes that I made after, this week, is, guys, like, especially in the earlier stages, right? I'm on my 0 to 6 figure journey. Technically my net worth is probably over the $100,000. Actually, I can guarantee my net worth is over the $100,000 mark at this point. But I haven't received that cash into my bank account. And so I'm trying to figure out what's the best way, but I'm thinking like, earning that amount, and then that's when I can cross that bracket. So I've done the work, I've planted the seeds, and now my net worth is there. But then I want to be able to actually, harvest it to ensure that I'm correct on those net worth numbers before I, cross into, hey, now I'm, in the 6 to 7 figure bracket. Just because the investments are going to change a little bit, going from net worth to, actually reinvesting. And that's kind of the purpose of the show. But in this phase, in this beginning phase, like you and I both, we have to stop buying depreciating assets and liabilities when we don't have investment income for no purpose, right? I'm going to preface that with, we're buying this fifth wheel. The reason that we're purchasing the fifth wheel is because we're going to be able to pull cash out of our house. We're going to own that cash. It's going to increase our net cash flow every month off of my job. So there's multiple positive reasons for buying it, but that fifth wheel is actually a depreciating asset in and of itself. So that's something to note. But I'm not just going out and buying a car as a liability, right? I'm not going to, really, at the end of the day, it depends on if you want to call it a depreciating asset. Robert Kiyosaki would call most of these things like, car. He'd probably call the fifth. Actually, no, he'd call the fifth wheel a liability because he'd call your own personal house a liability, even though it's an appreciating asset from an accountant's point of view, because it is a storehouse of value. It still costs you every month. And so we've got to stop buying the toys. We've got to stop buying the things that just cost us time, energy, money every single, let's just say period, because some might be every day, some might be every week, some might be monthly expenses, some might be annual expenses, but they all are costing us something, you know. A small portion of the investment income that, we earn, that can go towards the purchase of fun things and toys and, some depreciating assets and liabilities as we create that cash flow. For example, whenever with us, I've said this before, our active investment income, 10% of that goes to fund money. Now, a good portion of that fund money is actually going to be allocated towards getting a year of income set aside for me to be able to go fully back on self-employed. And so that's just kind of like an interesting way that, that's how we felt would be the best way to allocate our funds, where instead of the business having to pay me at first while it's just this little flame, how do we take the weight off of the business and just say, hey, this is personal finances. It's basically our savings. We want to use this in order for me to be able to go full time into just doing our own stuff, growing the podcast, growing, our investments and all these kind of things. But really, guys, like we need to be using our active income to create as much positive cash flow, to create as much, active investments, capital gains, cash flow as possible by buying assets to create this type of income. So, for example, moving into this fifth tool, we're going to create $1,600 a month of positive cash flow. What I'm not going to do is set aside $1,000 a month, to increase my lifestyle expenses to where it's like, oh, now I can go on crazy elaborate fun dates with Libby all the time. Now I can go, do all this, crazy stuff. I can go buy all this crazy stuff. I can go buy, maybe I could save up for a couple months and buy a boat, or I could save up for a couple months and go on a vacation. Like, no. That money is specifically for buying assets, for buying investments that are either going to create cash flow, or more importantly right now to us, or at least to me, is capital gains, because I want to get my money flipping really quickly. And then once I built up capital with my capital gains, then turning around and looking at how can I create cash flow. And so I would just encourage you guys, really look at your, even doing the wealth health checkup again. In fact, what I'll do right quick is I will link to the wealth health checkup, and I will add that to the YouTube and the Spotify description, so that way y'all can get the link for that as well. But really looking at especially that step one, how do you decrease your expenses, increase your income, one or both of those. It's kind of the big topic of last week, if I remember correctly. I think it was last week. To be able to create that positive cash flow. And then once you have that positive cash flow, be extremely intentional with that cash flow to go out and purchase assets that are going to be able to multiply your wealth. So it's going to be able to double itself, or have some type of strong ROI to create over and over and over again as you snowball your wealth. This gets a lot easier once your debt is paid off, because you can take all the money, especially if you're in debt at the beginning of this journey, take all the money that you were spending towards paying your debt every month. And, first off, when you're paying your debt, you're going to try to lower your expenses as much as possible so you can put as much towards debt as possible. And then once the debt's paid off, you just start chucking that money into the bank account every month, which is going to feel awesome. And then you're looking for an asset. You're going, what can I buy? What can I, create an ROI on? And then all of a sudden you get hooked and you're off to the races. Another interesting thing about intentionality, and I noticed this morning because we had an accidental overdraft fee because it pulled from the wrong account. And as you guys know, we have like an envelope system with our bank accounts. We got I think 12 or 10, 15 accounts, something like that. And one accidentally pulled from the wrong one. It was supposed to pull from another one. This charge that we had, and it was a pretty significantly sized charge. And as we had an overdraft fee, and as I was looking it up, I happened to stumble across a little piece of information. It said all U.S. banks together, this is from 2022, but all U.S. banks together make about $15 billion a year. 15 billion with a B, billion. $15 billion a year on overdraft fees and non-sufficient fund fees, according to the Federal Consumer Financial Protection Bureau. But the CFPB says that about 80% of that comes from just 9% of customers who keep getting hit over and over again with upwards of 10 overdrafts a year. Money that you're literally throwing away. Now, I called the bank and I was like, hey, this wasn't supposed to come out of it. It was kind of a partly on me, partly on the bank for the way that they structure everything. It was just a misunderstanding. They explained to me some things, clarified how they understood how the way it was presented wasn't very clear of how that would work through their system. So they sent me back the fee and made sure that it was pulled from the correct account this time, and got all that sorted. Got my $34 back because I'm not going to just let go of $34 because I worked very, very hard for my money. And so, but it's just thinking about that. Like I saw that and I thought that's a staggering number. Make sure that you have your books balanced to the point that you are not paying overdraft fees. Make sure that you have your books balanced to the point that you are not paying for expenses, for subscriptions, for even just random purchases on Amazon. I see them popping up deals and stuff like that all the time. That's just trash. Like, don't buy stuff all the time for things you don't even need. Libby and I right now, as we're transitioning into the fifth wheel, we literally have, so in our house, we've got 3 bedrooms. The girls have 1 bedroom. We have our master bedroom, and then KB has his own room he's been using as he's been sleep training. Most of his room right now, I would say probably 70 to 80%, is filled with stuff. It looks like a hoarder room. All this stuff Libby's been pulling out of cabinets, putting into his room. We've been filling it up to the brim, and with just stuff that it's like we've collected over time. Why do we have all this stuff? Why do we as Americans feel that we need so many things? It's insane. We live in this, this country of resources. And, a pastor friend of mine gave me a great point the other day. It was probably a couple months ago. He was talking about the way that Americans solve problems is when we see a problem, we just want to throw money at it because we're so resource heavy. And I have so many people that I even know, even people that I've worked with in the investment realm, people that they say they are absolutely broke, but they have so much stuff. Guys, I want to show you something. I'm going to be giving a Double Dare Your Money update soon as, we're transitioning out of the Double Dare Your Money for, 0 to 10,000 or 0 to 10,000. We're still in the 10,000 to 100,000 bracket right now, but I paused on eBay stuff because we were just absolutely swamped with everything going on. But I want you to look at this. Between stuff that we've sold from our house and stuff that we've sold on Double Dare Your Money, and we still have a lot more stuff to sell from our house. 90-day total right now is $1,004. $1,004 that we've made in the last 90 days off of eBay. And I would say at least half of that income came from stuff around our house that was literally just sitting in cabinets. And I'm not like I don't have some of the nicest stuff out of all the people that I know. I do have some nice stuff, but it's not like we're crazy bougie over here. Now, definitely we have been blessed in some ways. We have nicer things than what some would have, but there's a lot of people who have a lot more stuff than what we have. You know, it's been interesting as we've gotten into this RVing lifestyle journey, and we've just started listening to people's vlogs and podcasts and what they're doing and how they make it work, as we're trying just to understand what will this transition look like for us. How many people talk about moving out of houses that are 2, 3, 4, 5, 6, even 7? I think there was one couple that Libby told me about that moved out of a 7,000 square foot house, downsized. They live in one of these smaller places. And you talk about how intentional you get to be with your family and time, how intentional you are with your purchases and what you have, because you don't just have a plethora of space. We've lost that intentionality. We've lost that, doing things on purpose for a purpose. What we got to remember, guys, is that actions speak louder than words. So let's be intentional with our actions. And this would apply over all sorts of spaces in life. But specifically in building wealth, how can you be intentional with every single dollar that you have? How can you be intentional with every single purchase decision that you make? How can you be intentional with every amount of time that you're paid for? Because I don't know about you, but I want to have the biggest bang for my buck. And so what I would say is, if you want to raise, well, Double Dare Your Money would be a great place to start. Because let's just say, let me just look up here right quick. What's the minimum? Or here, let's do this. Let's say I remember that for the year of 2022, I think it was, the average take home, the average pre-tax income, $74,580. Now, I currently, after my pay cut, make a little bit less than that. We're going to be saving up about $20,000 a year, which is almost 30% of our pre-tax income. But I'm self-employed, so I get great tax breaks. I actually get tax incentives because I either work as a contractor or I'm totally self-employed in everything that I do. And so let's just say that you don't get a pay raise for the next 5 years. And let's just say that you can set aside 10% of your income, just for easy math, 74,580. Let's just say it's $7,000 that you set aside every year for the next 5 years, while also doubling the fund that you have. So year one, let's just say you set aside your $7,000. You don't even invest anything, you just set it aside. And then let's say over the course of the next year, you double that $7,000 that you're now holding, and you add in an additional $7,000 into that fund. So year one, you had $7,000. By the end of year two, you have $21,000. Now let's say that you're able to double that again. You're going to have to get aggressive about investing. You have to get smart about investing. You're not going to be able to just set your money somewhere, give it to somebody, and double your money. You're going to have active investment income, not passive investment income. This is going to take work on your part. So then say year three, you double your money again, you add another $7,000. So at the end of year three, you're now sitting with $49,000. Let's say you double that again in year four, and you add another $7,000. By the end of year four, you now have $105,000. Guys, you have more capital by the end of 4 years, which would be basically a college degree in investing, if you think about it, but you got paid to do it. That's my favorite type of education, is the one you get paid to do. By the end of 4 years, you have more capital than you even make in a single year. And then let's say one more time you double it and you add another $7,000. All of a sudden, that 7,000 is becoming inconsequential because when you double 105,000, you make 105,000. The $7,000 you're adding isn't even 10%, but we're going to go ahead and add it anyways. By the end of 5 years, you have $217,000. Now, at this point, if you're very confident in your ability to double your money, and you're able to get your life expenses down, you're able to get what you pay in taxes down legally, ethically, through some of the self-employed benefits, some of the, there's a lot of people talk about like tax benefits. Kiyosaki points to Tom Wheelwright for a lot of tax stuff. I haven't personally dug into a lot of his stuff personally, but I plan to when the time comes. But if you're at $217,000, let's just say you double that again. You're at $434,000, but let's say that you need to pay yourself out $50,000 for the year. Well, now you're at 384,000 for 217 to 400 and something. I forgot the number already. You lost, you took out $50,000 to pay yourself. You're now at $384,000. Guys, like, it just takes a few years to gain this financial freedom. And now, you know what the most exciting thing is? If a crash comes in the economy, you're no longer worried about your job security, because at this point, you're now holding on to assets. And you do have to be wise with your assets because you don't want to lose all of your assets. However, if the crash comes, well, now you're one of the only people in the market with cash. You can buy everything at the fire sale. It's like as if everybody in the United States or everybody in the country, or maybe even the world, depending on how big these crashes are, when you have these resets economically, whether it just be the stock market or it's the stock market and real estate, whatever it is, because they've happened several times, dot-com bubble, 2008, there's a whole bunch of other ones. They've happened, they happen back from, I've done this cyclical study, and I've studied all the way back to, I think it's like mid 1800s. There was I think it was in the late 1800s. I'd have to pull up my chart to know exactly when, but there was like the railroad crash where it's very similar to the dot-com bubble. There was a boom in the railroad industry. Everybody thought it was the next big thing, and it was the next big thing. But everything got overvalued until one day all the railroads just popped. And same thing happened with the dot-com bubble, right? It's just a new technology rose to the surface. It's the exact same pattern. We as human beings do this pattern over and over and over again. There's the Great Depression. There's a time when J.P. Morgan, this is, I believe, pre-Great Depression, testing my history knowledge here. J.P. Morgan Chase, Pierpont, what is I forget his first name. He actually had to bail out the U.S. government. So it's just interesting when you look at this. I forget where I was going with this, but being intentional, organizing your priorities helps you to be in a place where you're prepared to take advantage of, that's what I was saying, the going out of business sale that comes around every once in a while. But you're not going to get there by buying a whole bunch of liabilities and never buying assets. You're not going to get there by buying depreciating assets where, hey, well, you bought it last year for 10 grand, you could sell it this year for 7 grand. That's the wrong direction. We want to buy it last year for 10 grand, but we can now sell it for 20 grand or 30 grand or 40 grand, just like I did with the tax sale lot, just like I did with Hudson, right? We want to be able to find ways, how can we add value? How can we buy things undervalued to, sell higher, whatever it is, whatever the play is, even like a fix and flip. For example, property next door, picked it up for, the number breakdown on it, 128,000. I ended up wholesaling that for 138,000. I'm actually the project manager on that one as well. So it's kind of like a 2-in-1 combo. I'm getting paid to manage that project as well. So that I wholesaled for 138,000. It's worth somewhere between 260 and 300. Just depending on how nice we make it. And there's also kind of a neighbor situation, and with rates up, people are struggling to, pay as much for these houses. So we'll see exactly where it's able to end up being sold for. But you got to think the guy that I sold it to, let's just say, it'll sell for 260,000, and let's just say that there's roughly 6% in closing costs. And then let's just say there's some repairs and stuff that are needed, just for quick math and kind of overestimating. So let's say that 10% is deducted because of fees. You're now at 234. Let's say we put 45K into rehab. You're at 189, and I sold it to this guy for 138. So there's a $51,000 profit. Now, here's what I'll say, and don't worry, me going over these numbers, it's painful for me. But to think about 138 plus $45,000 invested, divided by a roughly $50,000 gain. So let's see, I said 138 plus 45. 138 plus 45, that's 183. So it's about 50 divided by 183, about a 27% ROI. If I did my math, I did it really quickly. 27% ROI. That's awesome, especially because you're going to be able to do that in somewhere between about 4 to 6 months. So you can do that twice, right? But if the ARV is more, it's worth more. If you can get other people's money involved with you, then you actually invest less capital. So then you can look at just what's your personal capital invested, and you're going to be able to have a higher ROI on your own personal capital invested. Now, for me, I actually put, let's see, I paid $100 for the earnest money, and I made 10,000. And so if you were to break that down, I have $100 divided by 10,000. Nope, did I do that wrong? It should be the 10,000 divided by 100. So I have 100. Am I doing this right? 100. It'd be 100. Well, no, if I break that to a percentage, it would be 10,000. 10,000% return on investment. $100 in, $10,000 back out. But I had to use my mind, right? I understood this process. I had to learn. It's taken me years to learn this process, to get better and better and better, and so, on one hand, I could have made a lot more dollars, but on this hand, I also have to look at, I have an incredible return on investment, right? But it still pains me because I wish that I have been wiser with my capital over time to take advantage of that fire sale when the opportunity rose, because then I could have actually purchased the property for that 128,000. I could have done the renovation for the same amount. My profit margin on it would have been 61,000. I would have had $10,000 less into it. And so if we looked at that example, I think we said it was 184. So that we had total into it. And so if we take that down by 10 grand, you're at 174, but then I made an extra $10,000 in profit. So 61 divided by 174, that's all of a sudden a 35% profit. If I did that twice, I have a 70% profit, almost double my money. But that is if it sells for only 260. If it sells for 280, and I can keep my closing costs and everything down to, let's just say, instead of 10%, let's just say 8%, so times 0.92. Nope, that was 0.95. So let's say 280 times 0.92. That's 257. Then if I subtract out the fact that I bought it for 128 and I put 45 into rehab, that gives a profit margin of 84,600. And then if I have 128, so let's just say I'm going to divide that 84,600. I'm going to divide that by 128 plus, oh, you know what? That just immediately did that. Anyways, I'm losing track of my math. I'm blabbering on right now. But be intentional with our money. Like, there's so many ways to be intentional with what comes in, how to move it around, how to allocate our funds. But it only takes a few years of intentionality to get where you're wanting to go. Educate yourself, be intentional with your money. Last thing I want to say is focus on your goals. Actions speak louder than words. Organize your priorities. So last week, I'm a part of the Robert Kiyosaki email newsletters and stuff like that. He sent out something about this trading program. And it's a little bit different than Andy Elliott's course. I was really interested in it. I was really excited about it. I love new opportunities. I mean, I love new opportunities. If you haven't seen that yet, me personally, it's just one of the things that gets my go. I just find them to be so exciting. But I really sat back and I thought about it for several days. I asked Libby to come in on this decision with me because, she's helping to balance me out, which is so good, so healthy. I really need it. And after thinking about it, after, she kind of reviewed the information as well, she's like, I really like the idea. I think it's something that could work. I think it's something that we should do. But we also both agree that our big focus right now needs to be real estate. As you guys know, I've done trading things with my dad in the past. And so she asked me, she was like, why don't you send this over to your dad? And, I was like, I've thought about it, but, I don't really know if this is actually an opportunity. I don't want to get anybody's hopes up. And she just encouraged me, not to not try to explore it on my own, to find something that works before I send it over. It's like, this is what partnership is all about. And so I sent it over to my dad and I was like, hey, like, I don't really know, if this is actually going to work or not, but it seems really interesting what this guy has to say. And, basically I was like, hey, would you run points on it? It's not going to take a big bankroll, but I'll bankroll it. And, let's just see what we can make happen. And he was very interested in it. But it allows me to continue focusing on what my big focus is right now is the tax sales, double digit money, the wealth legacy journey, building up real estate side of things. But then if we can get the stocks rolling as well, the whole idea with the bot was take whatever capital we can earn. Doesn't even have to be crazy amounts, but then immediately inject that back into assets, buying solid companies such as Apple, Costco, companies that we believe in, that we use their services. We purchase things from them. We know that they're large, reputable, strong brands. Coca-Cola, these Warren Buffett companies, and then also, real estate, buying real estate, digging into that cash flow. So anyways, I feel like I'm just kind of rambling on at this point. I've kind of lost a little bit of direction, so I apologize for losing a little bit of focus during this episode. I've had a bunch of work texts come in, and my brain's trying to stay here, but it's also wanting to go over there. So I better just go ahead and wrap this one up. But yeah, Lord, I just pray that you'd help me and everybody watching this, the Wealthy Legacy Journeyers, just organize our priorities, even if that's just writing it down, what's important to us. Getting out of debt, focusing on the family, being able to be self-employed, like whatever those goals are, being able to give, 50% of the income. Like I've heard all sorts of different goals over time from different people to be able to organize those goals and then be able to prioritize those through their actions, not just their words. I pray that I'd be able to show the priority of my goals through my actions and the actions that I take, not just my words, and that everybody watching this would do that as well, and help us to be disciplined. For the Lord does not give us a spirit of timidity, but of power, love, and discipline. 2 Timothy 1:7. So, anyways, I'm going to say our identity mantra before we sign out. I'm going to say it first. You say it after me. I explore the unknown. I conquer new frontiers. My journey is powerful, and my wake is a wealthy legacy. It's awesome, guys. And remember, wealthy is simply the ability to cover your monthly expenses without having to lift a finger. We are getting there every single week, week in, week out. We're making decisions that's going to get us to that place. And boy, I tell you what, is it going to feel good when we get there. Legacy is leaving a long-lasting impact on others who come after you as they receive the fruit of your labor. Whether that fruit be good or bad, all of us are going to leave some sort of fruit. Some of it's going to be good, some of it's going to be bad. Make the choices to plant good seeds so you can cultivate good trees, so you can leave behind good fruits. And just a reminder, guys, that in the description, I'm going to have a link to the movie that I talked about, the Wealth Health Checkup, and the Google Docs for a bunch of other resources. For a bunch of other resources. Sorry, I just got another text. For a bunch of other resources that help me in my own wealthy legacy journey that I want you guys to be able to have as well. With that said, I'm sorry for the distractions today. I appreciate you sticking with me. I probably lost some people, but you know what? Next week, I will work to be more one-track minded. And with all that said, guys, awesome hanging out with you guys, and I will see you on the next episode. Bye, everybody.